US recession risks are echoing across the Asian bond market with inflation rising to its multi-high levels. Undoubtedly, we will see repercussions on Indian sovereign bonds too. Rupee debt has been the most sensitive to an inversion of the US curve in the past, and this time is unlikely to be different, with the rupee hovering around rupees 80 against dollar and inflation above RBI's tolerance level. How should fixed income investors build their portfolio? In which direction will the Indian bond market head? Let's find this out, and I have with me Mr. Amandeep Chopra. Amandeep, good evening. Welcome to the show. First question to you. Where do you see the bond yields going up in India?
Good evening, Davita. I think, given the drivers which are influencing bond markets across the world, primarily inflation and secondly, the central bank likely to tighten rates further from here, I guess the direction for bond yields broadly should be trending upwards. So we will essentially need to look at how the trajectory of inflation going forward pans out. And secondly, to what extent will the central banks hike rates? As of now, one could argue that most of the information around these two aspects are known and would be somewhat discounted by the markets. But given the recent surprises that we've seen, let's say, for instance, the way the US inflation actually came, 30 basis point above market consensus estimates. Similarly, for India, there are still some upside surprises. So if any of those surprises really do play out over the next few quarters, I think, the expectation that the rate hikes could actually pause where they are currently priced at, which is 3.5 for the US and maybe between 6.5 for the Indian repo rate, can actually move up and hence influence yields going up further from here.
Right. How should a debt investor look at this opportunity in terms of making some profits or maybe revamping their portfolio? Do you think it's the right time to move your money into selected debt funds?
Yeah, surely. If you look at, just to give you a perspective where we are today versus where we were, let's say, 3 months ago as of March end, or even earlier than that, a year ago, clearly the entire yield curve has shifted up. So if you were to look at, let's say, where we were as of March end to now, the yield curve is up by almost between 120 to 135 basis point across the entire spectrum. Similarly, where we were, say, 1 year ago to where we are now, I guess the yield curve is upwards of 200 basis points. So I guess to large extent, the market and the current yields are already reflecting a fair amount of this reversal that we are now witnessing, both on the policy rate as well as on inflation outlook. So today rates are somewhat more attractive. In fact, if you were to look at, let's say, the 10-year segment or even, the 5-year segment, I would argue that, given the nominal rates, even on the sovereign bonds, you're actually at a level where you are getting somewhat a positive yield over the inflation trajectory, right? Over the inflation expectations. So unlike where we were maybe, 3 months ago or 1 year ago, where, given the high inflation rates, you're actually earning negative yields from investing in longer dated and longer maturity bonds. So the environment is definitely a lot more positive for bond investors. The correct strategy, given the fact that there is still some degree of volatility and a few unknowns out there, would be to start putting in a little bit of an amount of your overall fixed income allocation gradually. So this is in a way very similar to what I would advise is an SIP, right? Don't wait for the specific level. Just start putting in maybe 10% of your overall allocation on a weekly or a monthly basis, and that, in my view, could possibly fetch you a decent rate of return going ahead.
Right. Amandeep, since we have 16 type of funds if we talk about the overall debt category, it's very important for an investor to figure out what's the time duration of investment they want and what exactly is the goal lined up they are looking for to engage in with a particular debt fund that we're talking about. But before that, let's assume that we are into a deep recession. Maybe, obviously, the pressure is globally. I want you to explain the connection between bond prices, bond yields, and US in coming into a recession.
So to some extent, I guess the markets are of the view that given the upfront and aggressive rate hikes which the Fed will undertake over this calendar year, you could actually see the US economy tipping over into a recession, and hence, if you look at the longer term rates in the US yield curve, they're actually well below what the 1 and 2 year yields are currently quoting. So to give you a perspective, A 2-year US yield would be about 3.12 to 3.13%, whereas the 10-year is between 2.94 to 2.95. So clearly, the longer term yields are lower. Now, this inversion is also a market's own view that you could actually see the economy in a recession going forward. But the other way to look at this is from an investor's perspective that this also means that if the economy were to go into a recession, a typical response from a central bank is to start cutting rates and maybe reversing a lot of the tightening that they've done. Because essentially, they've in a way achieved their objective of hopefully with the slowdown of the economy and maybe even a near recession, some sort of a decline as far as inflation is concerned. So having met that objective, the central banks can actually now look to maybe sort of put their foot off the pedal and again try and focus more on economic growth and hence maybe start looking to cut rates going forward. So from an investor's perspective, I would say that these are good levels to buy into the markets. And as and when the central bank actually changes their stance, essentially implying that the rate cycle has peaked and is now moving downwards, you can actually get the benefit of not only having entered at relatively high yields, but also gaining from the capital gains when the second half of the cycle takes place. So that essentially is possibly what I would advise at this juncture.
Talking about this increasing inflation scenario, which we would see going a little longer, and majorly it's the global pressure that India is facing currently. What, according to you, should be a strategy in terms of locking your money for 3 to 5 years in a debt product? How should we look at it? And out of the 16 categories that we're talking about, which, according to you, would be the most apt as per what type of investor?
So again, I would not advise any one category over other.
Sure. Yeah.
The beauty of fixed income, product suite is that you have different category of funds to meet your investment horizon. So clearly, if there are needs for liquidity, and if you wish to keep some of your investments poised for maybe an alternate investment, it could be maybe if you feel the equity markets have corrected significantly and you wish to shift, or alternately there are certain expenditures, then I would recommend stay invested in funds which have a duration of less than 1 year. They sort of do not take on very high interest rate risk. And as and when the short-term rates move up because of the rate hikes, they reprice themselves, and you benefit from this overall rise in the short-term rates. However, if you have a 3 to 5 year investment horizon, I think there are two strategies to follow. One is a passive strategy, so you could look at funds which typically look at a target date, essentially matching the maturity of your investment horizon, which in a way insulates you from any interim interest rate volatility. What it effectively implies is that you enter into a fund with a defined maturity. Hence, all underlying securities would mature on a 3-year or a 5-year time horizon, and the yield that you lock into today is essentially what you would broadly achieve net of expenses and other such sort of leakages on maturity. So that's one way of investors looking to benefit from where the yields are today. However, the second part is also looking at some active strategies, funds which do try and capture these interest rate cycles. So maybe a small allocation to actively manage funds like the dynamic bond fund or a corporate bond fund would be appropriate for investors with a 3 to 5 year investment horizon. So no single strategy, in my view, given the the sort of various variables which are influencing interest rates and the economic outlook, would really suffice. So it's best to diversify across product categories, so you're able to benefit from things like a rate cycle, shape of the yield curve, and also maintain a fair amount of liquidity for any subsequent needs.
Sure. Diversification is the key. Specifically, if you talk about a financial portfolio that's aligned as per your financial goals, I think diversification is one strategy should be adopted all throughout your investment journey. But talking specifically about floating rate funds, which are the funds that invest in financial instruments that pays a variable or floating interest rate, do you think that could be a best bet in the current scenario?
Again, floating rate funds, are a good proxy to try and capture the interest rate hikes. So a small allocation within, your sort of low duration to short term allocation would be appropriate. But again, like I mentioned earlier, your investments in any of these funds should align with your investment horizon, because you must understand that all of these funds are running different durations. And if your investment horizon is short of that duration, then you are in a way exposed to interest rate volatility or impact of the markets. So if you really want to do capture the eventual yield of the underlying portfolio, then it's always advisable to match your maturity or your investment horizon with that of the fund. So in a way, you sort of don't get any surprises.
A lot of times we talk about, starting with your investment journey by, stepping up your investment. But then what about those investors who maybe are very close to their financial goals or maybe about to achieve their financial goal, and now is the time for them to move into debt? Now, for these kind of investors, what kind of product you think would be suitable to secure their capital and also the profit that they've earned in their investment?
So I think the right advice here would possibly be given by a financial advisor who would assess the individual's risk appetite and again various sort of liabilities. So I can't really suggest a single product or something which will sort of fit all. It needs to be very specific to investors. But broadly, what I can say is that if somebody has achieved their financial goals and wants to preserve capital with a decent rate of return, I think allocation which diversifies you across low duration funds, which are typically running deposit durations between 6 months to 1 year, combined with some short-term income products like a corporate bond fund, and then a small allocation to a dynamic bond fund would be very appropriate. Because if you look at the history of some of these funds, given the low credit risk that they carry, and how they've been able to capture interest rate cycles, these funds have actually given decent rate of return, which has actually beaten inflation, and you've not had to worry about losing capital.
Because fixed income looks so attractive at this point in time, can we go beyond debt mutual funds and maybe small saving schemes, which have not seen any rate cut in this recent time, are still looking very attractive? You also have a tax benefit. You think a debt portfolio where you can include debt mutual funds, small saving, or maybe a FD, do you think that it makes sense? Obviously, it depends on the investor's risk appetite, the kind of financial goals you want to achieve. But since debt is looking attractive, why not go for these schemes as well? What do you have to say?
Surely, given the nominal yields that you can get from a small savings investment, along with the tax benefits, do make them attractive. But I guess mutual funds, have demonstrated over a fairly long period of time now, since you have a history of over 2 decades, how they've been able to manage interest rate cycles and still not only beaten inflation, which means you got real, rate of return from fixed income funds, but you've actually been able to, over a longer period of time, get a very handsome rate of return, which actually at times is even beaten the small savings rate. So that's one element. So at a nominal to nominal comparable level, you have funds which have done fairly well. On a tax, again, a mutual fund does offer you certain tax incentives, which is largely in the form of being able to offset your long-term capital gains through indexation. So that again is an added feature of mutual funds. So if you were to say be a long-term investor in mutual funds, particularly beyond 3 years, you would note that fixed income funds, everything from short-term income to the dynamic bond funds, have delivered very good post-tax returns for investors after adjusting for the indexation, which is a benefit which you often don't get from other investment alternatives like a term deposit or a fixed deposit.
Since we are almost at the end of the discussion, I want to do a quick rapid fire with you where I want you to recommend us fund categories where if an investor has a time horizon for like 1 year, 2 years, 5 years, and maybe more than that, and the interest is debt mutual funds, what type of funds would you recommend typically?
So I think for 1 year, I would suggest investors to split their money between a money market fund or a low duration fund. And within the low duration, I guess there are certain floating rate funds which also don't run very high durations. That also can be a good combination. So, you could split your money between these two products for one investment horizon. If you have an investment horizon of 1 to 3 years, then I would recommend, an option between a corporate bond fund running a very high investment grade portfolio, or alternately even a floating rate fund which has a slightly longer duration. But if you have an investment horizon of beyond 3 years, then I think a combination of corporate bond fund, your target date maturity funds, or even something of a fund which runs a roll down strategy, which is very similar to a target date fund, but with an open-ended structure, can also be looked at.
Lastly, now we all know that debt mutual funds have given shockers in the past to the investors. Now, when you have to choose a debt mutual fund, what are the things that you should be keeping in mind? And maybe if you've experienced some kind of a shock previously, should not be repeated. What's the quality of papers? What's the quality of debt funds portfolio that you should be looking at?
So I think a lot of data is now available on the quality of portfolios and various analytics around debt fund portfolios. So some of the elements which you could possibly look at is sort of what is the profile of the portfolio in terms of the rating scale. So what kind of AAA, non-AAA exposures funds take. The second element is there is sort of a matrix called potential risk class matrix, popularly called PRC, which now has been implemented across funds. This data point actually tells you what kind of credit risk or interest rate risk a fund can take. So in a way, it caps the risk which a fund can be exposed to, and which is a good pointer for any investor or analyst to look at when he wants to analyze a fund. So one is where the fund is positioned today in terms of its portfolio, right? The second element is also how much more can the fund take in terms of both credit and interest rate risk. So I think that PRC classification of a fund would be a very important parameter to look at.
All right. With that, Amandeep, this ends the discussion. Thank you so much for removing time and giving us all the nitty-gritties about how to invest in a debt mutual fund.